Hi, I'm Pete Miller, President and CEO of the Institutes. We're a global not-for-profit whose mission is to educate, elevate, and connect the people focused on risk management and insurance. You're listening to Predict and Prevent, a podcast that explores how technology and resiliency can prevent losses before they occur. In each episode, we learn about innovative solutions and hear from leading experts on how they are making these approaches a reality today. The balance between fostering innovation and protecting consumers has never been more critical or more complex. The Institute's Griffith Insurance Education Foundation serves public policymakers by providing nonpartisan resources and programs designed to enhance understanding of insurance and risk management. With that mission in mind, I invited Frank Tomasello, Executive Director of the Griffith Foundation, to host today's episode featuring a timely conversation with a regulatory leader navigating these very challenges. Insurance regulation is evolving rapidly as new technologies and climate challenges reshape the insurance and risk management landscape. Be in excellent hands. Take it away, Frank.
Thank you, Pete, for the kind introduction. The institutes and its affiliates have been exploring opportunities to combat some of the biggest risk challenges facing society today by leveraging innovation and technology to better predict, prevent, or mitigate loss, and so too have public policymakers. In this edition of the Predict and Prevent podcast, I sat down with the Honorable Scott A. White, Commissioner of the Virginia State Corporation Commission's Bureau of Insurance, and President-elect of the National Association of Insurance Commissioners, often referred to as the NAIC. He shared his perspective on regulatory efforts to encourage innovation aimed at better predicting, preventing, and mitigating loss. To begin our conversation, Commissioner, from a macro perspective, how would you describe the efforts of the regulatory community to better predict and prevent loss? And would you care to respond by focusing on a specific risk or risks in particular?
Well, thanks, Frank. It's great to be here and talk about these very important topics. I think when it comes to regulatory efforts to address risk mitigation, it's really following and understanding what the industry is doing in terms of predictive analysis, that they've really become more refined over the past several years. And that requires us to be on top of that and better understand both what they're doing and the impact of that. Of course, as regulators, we're focused on consumer protection. And so that raises a number of issues in terms of data that's used for their predictive analyses, making sure it's both secure and protected, but also how it's used and the validity of the data. So we've had to get up to speed rather quickly in terms of learning this and understand this. So we've had a lot of collaboration with the industry to better understand how they're using it, in what areas, what their governance is, how they're mitigating the risks. I think the basic message I would give from the regulator community, Frank, is we want to encourage this type of innovation. We know it has a lot of benefits to consumers in a wide range of areas, but we have to make sure that there are what I would say guardrails in place to protect consumers. And so we've been kind of on a journey as we've seen the advances in this technology to learn what that is again and make sure we have the tools to protect consumers.
Thank you, Commissioner. I'm curious, with emerging AI technology helping to advance loss prediction, one would imagine, given your comments, that ensuring transparency and avoiding discriminatory outcomes are likely top of mind for the regulatory community. Could you share a little bit about sort of your thoughts there and perhaps how the NAIC might be approaching some of those issues and tackling them?
Yeah, I think it helps to maybe think of an example of where we're seeing that. Predictive rate modeling, we touched on that just a minute ago. That's an area that first came to our attention as to where we need to really spend some time and focus, because there's a number of different risks there. In fact, when you're talking about technological innovation, I like to break it into three components. The consumer protection piece, which I mentioned, and that gets into unfair discrimination. We want to make sure the data is being used in a way that doesn't discriminate unfairly against consumers from an actuarial standpoint. And then data privacy, of course, which we're also working on at the NAIC, and then protecting against the risk of cyber threats, another area we've been spending a lot more time on. But when it comes to predictive rate models, we've seen growing use of that companies use, particularly when on the property and casualty side, when developing rates, let's say for their personal lines, auto program, or homeowners. And so when we get a filing, a lot of in our states, the way our rate review process works, we don't actually necessarily approve those rates, but we make sure they adhere to certain standards, that they're adequate, not excessive or unfairly discriminatory. So we will look to see how they're using that data. And the concern there is around proxy discrimination. They may use a factor that they believe reflects a certain risk and adjust the premium accordingly, but that could intentionally or not implicate certain protected classes, or just not align with treating similarly situated risks the same way when it comes to pricing. So we've had to dig into that. We do that two ways. A lot of us either have an actuary who is able to analyze some of these filings, or a consultant, but it really has to do with asking the right questions. We're not experts, and it's very time consuming given the number of filings we have. So we do have a number of questions we can ask in terms of where they got the data, the hygiene they used, how they developed the risk factors, and came up with these variables. So it's a process that's gotten much improved over the years, and I expect it will continue to be something that we get better at.
Is it fair to say that transparency is of utmost importance as we think about model design and model outputs, and perhaps about the dovetailing of industry, consumer, and regulatory voices?
That is absolutely a great thing to focus on. I would highlight three areas when it comes to looking at AI and machine learning models from a regulator perspective. We want to make sure it's transparent. We want to make sure that the insurer is accountable for how they're using these AI systems, and they want to make sure they're fair, as I touched on before. So to emphasize the fairness piece, we have to know how they're using it, right? We haven't really focused at the NAIC when it comes to regulating AI and the use of these systems on kind of an outcome-based approach in terms of testing these systems. We really look at the process and whether governance is in place. And so that requires us to have a very firm understanding of how these models are being used, whether they're being used directly by the company or they're relying on a third-party vendor. There's been a tendency to have kind of a black box approach when it comes to some of these filings, given the proprietary nature traditionally. And we've really had to work through that issue. I think the industry understands our need to look at how these systems are used and run through the processes, run through the governance in place. And so that's been something we've worked on. And I think we're there, although we still have a lot to learn. One thing we're noticing is how rapidly the shifts are in terms of how companies are using them in what areas. And it's something when we go back and ask for an update, we find it completely different 6 months later. And the other piece that you mentioned is there needs to be transparency to consumers in terms of how their data is being used. And so from that standpoint, we've been trying to update our privacy models to make sure it reflects the current state of where we are. Some of these privacy regulations in many states haven't been updated in over 30 years, and they don't really account for how data is collected by insurance companies, used, in some cases sold. And so that's been a project at the NAIC that we've been working on for almost 5 years with the industry, and hope to get something completed there by the end of this year.
Thank you, Commissioner. I want to switch gears from the discussion we've had around predictive modeling, its promise, and some of the privacy considerations, among other things that we've talked about, to the notion of resilience strategies. Opportunities for mitigation, no doubt, are important. What is the thinking amongst NAIC leaders regarding encouraging insurers to offer incentives to policymakers who adopt preventative and or more resilient measures? I'm thinking about things like flood proofing and fire mitigation, that kind of thing. Could you share some insight there for us?
Yeah, I think you've hit on, one of the more interesting things going on in the regulatory community and industry-wide If you had asked us 3 or 4 years ago about resilience or mitigation efforts on the part of the industry, I'm not sure we would have been in a great position to talk about that. But if you go to any meeting today, it's top of mind. It's almost the first thing we discuss, not only given the need to address some of the issues in the property insurance market that have become more acute in the last several years, but just shifting our overall idea of what the role of insurance should be, right? Or emphasizing the part that is not just indemnification, payment of claims, but also stretching into loss prevention, right? And the need to really focus on that in terms of bending the cost curve. We often cite to a study that shows for every dollar that's put into mitigation or resiliency, that can save up to $6-7 on the back end when it comes to claims. So it's in everyone's interest to put in place measures that prevent losses, lower claim costs. That's going to help the cost of the actual insurance for the consumer. And it's also going to create an environment where companies are more favorably inclined to write business.
Commissioner White, on the consumer side, is the NAIC thinking about or involved in promoting public awareness campaigns, perhaps to encourage risk prevention and mitigation on the part of consumers? Are there efforts underway perhaps there or perhaps within your state in particular? Anything you want to share on that front?
Yeah, it's a good question because you're seeing a lot of these programs develop in a number of different states. We like to tell the story of this originating in Alabama with Strengthen Alabama program. And what this is it provided grants to homeowners if they rebuilt or built their roof to a fortified standard developed by the IBHS, which is an industry-supported group that has developed this very strong building code. And there was an idea that incentivizing this program through grants and helping facilitate that through staffing within the department and coordination with the industry and consumers would do exactly what I said a few minutes ago, would be strengthen their market and make insurance more affordable, particularly in those coastal areas in Alabama that are subject or prone to hurricanes. And that's exactly what we've seen. And of course, in the U.S., the state-based system, we talk about the laboratory of ideas among the states. And this was an idea that other states saw as working. They saw similar issues in terms of the risks in their own markets. And it's been widely adopted. I think if you talk to the NAIC, they've hired staff to do nothing but assist states in standing up these programs legislatively or otherwise. And as many as over 40 states are in some stage looking at this program. And I believe about 15 to 20 have actual legislation or in the process of legislation passing. So the one thing to consider is each state faces its own unique risks. Again, this emphasizes the appropriateness of the state-based system, the local markets and conditions. We're more able to respond to those and address those, but also zooming out, working collaboratively with the other states to ensure, best practices will, lead to the right solutions. And so I know Minnesota has one that deals with the major threat in their state, right, which is, I think, hailstorms. You go out west and, of course, wildfire risk, and you have a lot of states building up those programs. You can do it in one of two ways, Frank. A lot of times it's a grant program or offering through the product design in the form of lowering the deductible or other features to incentivize the use of that. We're in a period where funding is more at risk or more uncertain. So we're all trying to figure out how to sustain these important programs because they've really gotten hold in the industry, and the regulatory wants to do everything it can to support those. But when it comes to education, consumers need to be aware of these things, and that's where we find we have a real job to do. Right? It's one thing to provide these grants or make sure folks can go to companies that are offering these discounts, but they have to know about those first. So we have a lot of discussions about what can we do in our role as regulators, what can the industry do, what can other stakeholders do. It's a key piece of this whole puzzle that doesn't often get as much attention. But what we found is it's tough to get through to the consumer who's buying a home, for example, or sustained a natural disaster, to focus on that piece of it. It may not be top of mind.
Commissioner, undergirding insurance and risk management in the U.S. is, and you referenced this a bit earlier, a decades-old regulatory framework, a state-based framework of regulation here in the U.S. And I thought we might spend some time exploring strengths and challenges through the lens of efforts to better predict, prevent, and mitigate loss. Do you foresee a need to adapt that regulatory framework to keep pace with the rapid advance of technology that's focused on prediction, prevention, mitigation? Or, in your view, is the framework sufficiently malleable? You've talked about a number of successes and efforts underway, but just curious to get your view there.
Yeah, I think that, as we look at how the regulators have approached, just focused on what we've been speaking about, how do we regulate properly the use of AI systems? How do we address the more acute risks in the property markets raised by natural catastrophes and other factors? I think it's proved to stand the test of time. It's certainly not perfect, but what I think we look at in terms of its strengths are the state lab approach that I touched on, developing unique solutions, and then those being adopted by other states. If they're market tested solutions that are in response to local conditions, you can adapt accordingly. But it's the idea of being able to draw on the creative approaches by other states to come up with better solutions. It would be much more difficult to develop at a federal level. I think our approach, from a standpoint of how we regulate, it's very flexible. It's risk focused. It's principles based. And what that means is when you have emerging risks like AI systems, you don't have to create a brand new framework. In fact, for example, when we decided the best approach to coming up with a framework, we didn't develop a model law or model regulation. We developed a guidelines, a paper that basically said we have the laws in place to regulate AI systems in terms of market practices or consumer protections, and we adjust those accordingly without any need to wholesale create a new framework. Now, there may be gaps, and if we identify those gaps, there may need to be changes, but generally we have found it to be sufficient and strong. And I would say the same thing with another quote unquote emerging risk with cybersecurity. We used our existing laws, created some adjustments to those laws in terms of notices, but within the framework of how we handle notices generally. And we found it to be very effective. I think taking a risk-based approach that's flexible, that addresses proportionality, where you have large insurance companies versus smaller insurance companies, and the materiality of risk has proven very durable. And so, I'm very supportive of how it works. Now, some of the challenges are when you have 56 jurisdictions, you face the potential for a lack of consistency. The process can be much slower than we would like. And in some of these areas, achieving consensus is more difficult than it might be with a more top-down approach. But I think the benefit you have at the NAIC is you have a lot of transparency in the process. You have a great amount of stakeholder involvement that's oftentimes lacking at the federal level. And so what comes out of that, I think, is very durable and strong. And it's something that we're very proud of in terms of how our regulatory frameworks get developed.
Commissioner, you just mentioned the federal level. So maybe a good opportunity for us to talk a little bit about and obtain your views on the importance, perhaps, of collaboration and information sharing between state insurance departments and federal agencies. Agencies, for example, like FEMA. I'm not excluding others, obviously. But could you talk a little bit about that through this lens of loss prediction, prevention, mitigation?
I think it's very important to develop and sustain good working relationships with federal agencies, regardless of which administration is in place. They have their own expertise, they have their own resources. And when you combine those, it's better for our markets and it's better for consumers. And so we have really worked hard to collaborate and coordinate with a number of different agency or groups at the federal level. You mentioned FEMA. The NAIC and FEMA have an advisory group where we collaborate and share information. And it's become increasingly critical to have these efforts, given, again, the state of the property insurance markets and the increasing burdens on both the states and the federal government when it comes to responding to these and keeping the federal flood program in place. So that's a key one. But I would also mention when those efforts where it might be a challenge, we're seeing that with the NOAA. And right now, on the current state of things, information that was readily available maybe a few months ago, it's less clear whether it's available now, and that raises concerns from our standpoint in terms of needing that information, both as regulators and as the industry in terms of developing rating and claims information. So it's something we're working with the federal government to make sure that continues.
Thank you, Commissioner. Shifting gears a bit and looking ahead, perhaps 3 years and then 5 years from now, what do you foresee? How will efforts of the risk management and insurance ecosystem to better predict, prevent, mitigate loss, how will they have evolved?
That's a great question because it's hard to predict what's going to happen 6 months from now, much less 5 years ago. But I think if you look at trends and where things are headed, obviously the industry is becoming much more sophisticated in how it uses data. And as a result, there are many benefits, which I like to focus on. It's going to be more responsive to consumers. When you have better data, you have better models, you have better collaboration tools. We're going to see real growth and acceleration in use of AI systems, rather. I think that's fair to predict. You might see things like real-time risk monitoring, which it matches more accurately the cost of that insurance to the actual risk. And in most cases, that will lead to lower premiums for a lot of policyholders. And it will lead to a healthier balance sheet for a company that's able to have that certainty in terms of developing its rates and its reserving. You're going to see much more dynamic pricing models, much more predictive analytics becoming much more mainstream. An area we should focus on is the climate modeling, which is obviously extremely important. I think we're seeing that become much more sophisticated. We've moved from relying on historical data to using scenario analysis and other more sophisticated tools to better predict the risks. Hopefully that will lead to more discussion and involvement on resiliency infrastructure, which gets to the need to scale up all the efforts that are ongoing in terms of private-public collaboration. And in areas such as risk-based land use planning is something we're hearing more about. In other words, address this issue holistically and really get to the core causes of why the industry is suffering losses more than it's bringing in premiums. At the end of the day, I think there should be an understanding that regulation isn't just about protecting consumers after the loss. As I said at the beginning, again, it's about working together with the industry, with other stakeholders, and try and prevent more of those losses in the first place.
Commissioner, is that notion of a holistic approach, is it fair to say that in many ways may essentially be a pivot from perhaps a more traditional approach of transferring risk through insurance to a broader approach of risk management, a more holistic risk management approach? And if so, one would imagine that includes stakeholders from various positions within the insurance ecosystem, including consumers as well. Is that essentially what you're suggesting there?
That's a great way to put it. Risk management is something the industry does better than anybody. And again, developing that and sharing that information, sharing that knowledge with, say, a community that's trying to address rising sea level, as we are here in Norfolk, or nearby in Norfolk, Virginia. I'm actually traveling to Washington in a couple of days to talk in front of the National Realtors Association. And again, they're quite interested in understanding The impact of insurance on the cost of buying a home is something, as we talked about earlier. It's not something that consumers necessarily factor in, and they can't afford not to with the rising cost of insurance in many cases. So that's an area of identifying the risks and managing those risks, and that requires, again, like you said, there's a wide ecosystem of stakeholders that need to be operating under a similar framework. And I think that's where the industry can lead with its data, with its practices that have developed over centuries. And they can play a real leading role in this area. And I think they're excited about that. I think they understand that they do have a role to play when it comes to addressing this issue. And we as regulators do as well. So it's an optimistic message to get out during a time where there are real problems that need to be addressed.
Thank you, Commissioner. Any parting words for our audience here on the Predict Prevent podcast? Anything else you'd like to share?
I think I would just say, I think you hit on all the issues that are top of mind. You must be going to our meetings because there's a real sense that we have moved into a different period where, again, we're focusing more on the more sophisticated risk management practices that the industry is bringing to bear to create positive solutions. But that also puts a real challenge on us to, again, make sure that those guardrails are in place. We want to encourage innovation. We want to encourage resiliency and mitigation efforts. But we have to make sure that they're done in compliance with our laws that are designed to protect consumers. So I think the industry and the regulators are aligned with this approach. And so we look forward to continuing working together with the industry and other stakeholders as we move forward.
Commissioner White, thank you very much for visiting with us today on this episode of Predict and Prevent.
Thank you. It's been great.
Predict and Prevent is a podcast brought to you by the Institutes. Subscribe on your preferred listening platform and join us for future episodes where we continue to dig into this approach and the opportunities it's creating for risk management and insurance.